As we look back at the first half, the North American Income Trust managed nicely through a very difficult set of volatile markets, with total returns negative 1.2% on an NAV basis, and that compared favorably to the Russell 1000 Value, which was down 4.3%, and the more defensive S&P High Yield Dividend Aristocrats Index, which was down 3%. Of note, British sterling gained approximately 5 percentage points versus the US dollar, which did dampen returns during this period. At a high level, when we look at the sector and stock contributions, we saw good stock selection across financials, technology, and consumer staples. And partially offsetting this was weakness in consumer discretionary and communication services. Dividend growth for the trust continues at a strong clip, with roughly half the portfolio raising their dividends in the first half of the year by an average of 7 percentage points. The North American Income Trust paid out 5.6p in dividends, and as a hallmark of the fund, continues to have a very strong revenue reserve account with revenue reserves in excess of 14 months. The board does remain committed to a strong progressive dividend. Finally, share repurchase continues in the trust as we continue to buy back stock, trading at a discount in the high single-digit range. And in this first half, we repurchased approximately 3.5 percentage points of these shares outstanding.
Two of our top performers during the period included Eaton Corporation and Broadcom. Both continued to benefit from the strong demand signals for AI infrastructure and data center expansion. Eaton benefited from continued robust sales and margins, particularly in their electricals business, while Broadcom continued to see really strong demand for its ASICs and networking products, and recently increased their long-term guidance due to significant customer additions. We also had challenges in the portfolio during the period. Two of those included Bristol-Myers and Accenture. Bristol-Myers faced additional competitive pressure from generics in part of their portfolio, and did have a couple of disappointments in their pipeline. While Accenture saw modest revenue growth again in the period due to spending and technology being shifted towards AI as the company continues to build its AI brand. Both companies continue to pay attractive yields, but we will obviously continue to monitor those positions. We did make some additions and subtractions to the portfolio during the period as well. Three of the largest additions included Trane Technologies, Corteva, and Disney, all of which pay around a 1% yield. So our expectation for these positions is for them to drive capital appreciation. And each of them over the trailing 12 months has seen a roughly 20% earnings growth. We also added to our positions during the volatility that we saw mostly during the April time period, and we elected to add to more cyclical growth companies like Eaton and Amphenol, which again continue to benefit from this AI infrastructure build out. As far as reductions during the period, we trimmed our position in Johnson & Johnson, as well as Verizon, and exited our position in Cisco, as well as IBM, all of which are more defensive names with lower earnings growth. And so we used those proceeds from those positions to reallocate to faster growing companies during the period.
As we look forward, it's important to obviously look backward because the trade policies, the implementation of these, provided a very volatile backdrop in the first half. And while not complete, we feel pretty good about where the trade policies and tariffs are headed. Importantly, corporate fundamentals during this period have largely remained strong as corporates have been able to cut costs where needed, but also have good visibility on revenues and good visibility on pipelines. And we feel very comfortable with the North American Trust portfolio companies. I think this bounce back, what it has done is it's given the market a chance for multiples to re-expand. So multiples are back to that 22, 23 times. And I think it's important when you look at North American Income Trust, it's a growth and income portfolio. We're still looking for earnings growth. We're still looking for strong total return as well as income. And valuation is a very important part of our process. The average multiple of the stock in North American Trust is currently around 16 times. When we step back and look at the implementation of tariffs and trade, I think we need to look at it holistically in combination with the new fiscal bill that offsets some of the headwinds here. So specifically, the tariff and trade policies are viewed as a bit of a consumption tax or perhaps a value-added tax. So this will impact consumers and corporates, but it's also being shared by importers and exporters as well. So some of this headwind, as far as higher costs coming through the system, will be offset, and we feel very good about this pro-growth fiscal bill that incentivizes corporates on capital expenditures, it incentivizes for R&D spend, as well as a little more generous interest rate deduction. This bill is also very favorable for the consumers. It strengthens them with a series of incremental deductions that they'll be able to experience, largely starting in 2026. This will help offset some of the higher costs that are going through the system, and I think at the end of the day puts the consumer and corporates in a better, healthier balance of investment offset with more generous consumer deductions. The final piece of the macro here is monetary policy, and while there was a recent cut in September to lower rates, employment still remains a risk as employment has weakened a bit and the Fed needs to be data dependent in their decisions. Importantly, monetary policy comes from a fairly restrictive spot, so lowering rates will simply just bring monetary policy down to a neutral rate, which will help both corporates and consumers going forward. So we feel pretty good about that. The next Fed meeting is the end of October, and we look forward to their decisions.
Macro side, we continue to be really excited about the innovation and the productivity gains that U.S. companies continue to realize. A lot of that has come from the digital investment as well as now AI investment that's taking place for U.S. companies, which has accelerated their ability to realize productivity, but also has put them in a position to accelerate sales growth as well as they've been able to invest more in sales driving investment categories like R&D and sales and marketing. We also think in periods like this where we have high investment spending on attractive opportunities like AI, it's important to invest in companies with substantial scale that are industry leading because they have the budgets as well as the capabilities to take advantage of these transformational technologies. Lastly, as you would expect, we continue to focus on resilience in the portfolio. We continue to prioritize strong balance sheets, healthy free cash flow, and resilience depending on what the market and the macroeconomic environment brings to our companies. And with that focus on resilience, we continue to think that the portfolio is well positioned going forward.